Just a quick, oh, okay. So just a quick overview of HubSpot for Startups for those of you who may not be familiar with us. We partner closely with accelerators, incubators, VCs, and other investors alike around the world, like Bridge for Billions, to accelerate growth for their startups by running exclusive educational and webinar opportunities like this, focused on building sales, marketing, and growth strategies in today's economy. So if you are part of the Bridge for Billions community, then you would be eligible to receive specialty pricing where you can potentially get up to 90% off the software. If you're interested, feel free to apply to the program at hubspot.com/startups or connect with me if you have any questions. We really love startups and entrepreneurs. So in addition to our startup program, okay. So in addition to a startup program, HubSpot also has a 30 million venture fund for startups that aligns with our mission to help our ecosystem grow better. So check it out. And if you have any questions, feel free to connect with me. Quick ask for Phoebe and Alex, if you don't mind. In the meantime, if you could maybe help answer some of the questions or moderate some of the questions during the session. I'll try to have them answered by the end of this session.
Sure, will do.
Thank you. So, well, quick intro of myself. So I'm currently leading our partnerships in the Eastern US, and I am based in Boston and helping startups grow through mentorship and advisory. So I took a conventional path and started my career in the financial sector, where I spent a couple of years in both public and private capital markets. And then throughout my time in the financial sector, I always felt that something was missing and didn't really get much fulfillment out of it. So I ventured into the startup world, where I first joined an accelerator, then a venture group based in Hong Kong, advising and assisting startups with fundraising. And that ultimately led to my journey into HubSpot for Startups. So what are we talking about today? Quick snapshot of today's agenda. Firstly, let's walk through where you are standing financially today. Secondly, we'll assess the scenario and take action accordingly. After that, we'll go through some tactics to help you become more equipped to face the crisis. I'll present my insights and thoughts to help you implement these tactics. Finally, we'll wrap up this session with a summary of lessons learned that you can immediately take away from and adapt to your situation today. We'll also open up to all questions at the end. So again, feel free to pop them into the chats during the session. We'll have about 15 to 20 minutes at the end of this session to have an open discussion. Now, without further ado, let's dive into it. So first and foremost, I would really like to give my acknowledgement to Professor Steve Blank. He's a professor at Stanford, and a majority of the content being presented today is actually in reference to a lot of his thought leadership and a combination of my operating experience advising companies on capital raising best practices. Now, in order to understand where you are standing financially today, we must go through 3 stages. First is to understand where you are in the startup life cycle. So for those of you who may not be very familiar with a startup life cycle, this diagram here essentially sums it up. It's a typical financing cycle for a startup company. And what I would really like you to take away from this is to understand what stage your startup is at, and where it's at really matters. So based on the age and market position of your startup, there are different financing opportunities available to you. Early financing occurs when money is raised from angels, friends, and family. And I like to think of the life cycle of a startup in 3 phases. The first phase is the search for product market fit. Increasing customer traction is the best way to prove to investors that you really have reached product market fit. And then The second phase is the search for a repeatable and scalable sales model. Reaching this milestone will then greatly increase your valuation and attract growth stage investors who like to invest in companies who are ready to scale. And once a startup enters the third phase, scaling the business, it will usually start to see its valuation increase linearly. So as a startup, you might be navigating your way to profitability. You often raise early stage funding to prove that your tech and business models work and that the market wants what you're selling. And when that takes longer than expected, you can really find yourself maybe nowhere close to reaching the milestones necessary to raise the next round of funding. This is what's commonly called the valley of death. It's that gap between when a company first receives funding and when it begins to optimize for sales from paying customers. So let's deep dive into venture capital performance through past recessions to better understand the impact of the upcoming or current recession that will have on industry. This shows the funding activities during and after the financial crisis in 2008. And what we can see here is that there wasn't much of a decline in funding activities for C rounds. Angel and pre-seed valuations actually counterintuitively went up for the first 1.5 years after the recession began. But there was certainly a big drop in funding for Series A through C after the recession, showing a roughly 2-year gap before reaching recovery. So there seems to be a delay effect on the early stage VC. The good news is that if you're in the pre-seed or C stage, then you're not as strongly impacted by public market downturns as later stage startups raising for Series A through C. So my question to you is, what stage is your startup at? Feel free to pop your answer into the chat, and I'm really curious to hear from you guys. Let's see, how can I? Okay. Don't be shy. What stage are you guys at? Pre-seed? Great. All the early stages. Awesome. Are completely new. Okay. Awesome. Awesome. That's good to know. All right. Back to present mode. Okay, so sounds like most of you guys are actually in pre-seed or C stage. I'm assuming most of you are in that stage. So now that you know and understand what stage your startup is at, what you really need to understand next is the magnitude of the crisis you're facing. So let's walk through a couple of questions you should try to answer to help you evaluate. So first is, how will the crisis affect your startup? Second is, how will the crisis affect your clients? Chances are, if your clients or customers' install base is impacted, then you can avoid being impacted as well if that changes their payment terms. Third is, how will the company affect your industry? Then how long will the crisis last? Finally, how long will the effects of the crisis last? I think the last two questions are the most critical. The COVID crisis obviously has transformed the global business landscape and created a ton of uncertainty through every business sector. Certain companies may be uniquely positioned to thrive and are pursuing investment opportunities in the space while others are suffering financially. So you should really try to answer all of these questions on your own, because your answers or the way you approach these questions will help you determine the best course of action. Obviously, we're all facing the same crisis here, but the magnitude of the crisis you're facing may be vastly different than the others in the room. it pertains specifically to your industry, your sector, and your business. Think about what the upsides and downsides for your business are. For instance, COVID has changed and obviously will change the way we work forever. And of all companies, Zoom has really risen to the top because of this. So now that you understand the magnitude of the crisis you're facing, what you need to do next is to perform a general financial assessment to understand where your startup is financially. And there are three components that go into this process. First is to do a quick startup assessment. And anyone familiar with the concepts of cash burn rate, cash runway? So I assume most of you do. Simply put, cash burn rate is the amount of money you spend during a period of time. If you're a seed stage startup, then you should be accounting for your cash burn rates from month to month. It's also important to highlight the monthly burn rates and runway until the next financing is required. Cash runway is essentially how long your cash will last at your cash burn rates. These are common metrics of performance and valuation for startups. Something to keep in mind is that because a startup is often unable to generate a positive net income in its early stages because it's usually focused on growing its customer base and improving its products, C-stage investors or VCs will provide funding based on a company's burn rate. So the way to calculate cash burn rate is quite simple. First, you find the difference between the starting and ending cash difference for the period. And then you divide the total by the number of months in the selected period. And there you have the cash burn rates. So let's say my company had $20,000 prior to the crisis. Fast forward to 3 months, I now have $11,000 as an ending balance. The difference is $9K. If I divide $9,000 by 3 months, my cash burn rate is $3,000 per month. So to calculate your cash runway, all you have to do is take your total cash reserve and divide it by your cash burn rate. Let's say our total cash reserve is $11,000 with my cash burn rate at $3,000 per month. Can anyone tell me what my cash runway is? Oh, sorry, click the wrong button. Go back to percent. It's 3.67, right? So now you understand your cash runway. Do you have more than 18 months to burn through? Even better, do you have more than 24 months? If you do, congratulations, you're in a better financial state and should have sufficient runway until your next financing round is required. If not, as a startup advisor, I would strongly recommend you taking actions now. Let's review some of the tactics to help increase your runway. Now, something to keep in mind is that unfortunately, it's no longer a normal market. All your assumptions about customers, sales cycle, revenue, burn rates, and cash runway are no longer true. You might have calculated your runway to last until you raise your next fundraising round, and there were growth expectations from investors prior to COVID. You might have thought to yourself, get to these numbers and your next funding round will be guaranteed. That may be no longer true. Keep in mind that during COVID and likely beyond, company expectations have already been adjusted. Growth economics are important, but there are also now new indicators that investors look for that will determine if your startup will actually thrive post-COVID as well. So obviously, we're in exceedingly strange times and the world is changing from day to day. So you might want to consider performing this type of financial assessment on a weekly basis and understand where you're standing financially at all times. So next is to perform an external assessment, and there are 4 components to it. First is the state of the economy. Second is the health of your current target market, which is the most critical in my opinion. Third is the emergence of new markets. Are there new opportunities out there? Where to find new markets and customers? Finally, the forecasted recovery date. When can we expect to go back to normal and buyers start buying in the new normal? Keep in mind that the crisis and recovery will create a new normal, as we just talked about. The current crisis has fundamentally changed the market and upended the business models of a lot of startups and existing companies. So as the economy reopens, we might be finding that customers may have disappeared or that their spending behavior has changed. The next phase of your assessment is to perform an internal assessment. You want to assess your operating numbers. Look at your liquidity and estimate your likely cash zero date under your worst case scenario. Look at your accounts receivable, accounts payable. What's your sales pipeline forecast? What's your marketing programs spending? Look at your payroll costs or other variable costs. Take the time to really look at all your operating numbers and understand when your cash runs out. Work with your CFO and C-level staff together until this is done. That will start to get your team aligned about the size of the financial problem you're facing. I know the concepts in this presentation will likely be obvious to experienced founders and entrepreneurs, but our experience indicates that entrepreneurs still frequently make avoidable mistakes with their financing strategy. So being able to explicitly think it through or build a financial model may be helpful. You may also want to consider sources of outside capital. So for existing companies, this can be debt commitments, new lenders, or even the PPP loan in the US. For startups, if you were raising money, validate whether your investors are still on board with the same terms or at all. If your company is about to raise funding from current or new investors and you have very little time available, then you need to make sure to decrease investor risk in order to increase your chances of success. Obviously, that will also get you a higher valuation as well. So question for you guys, why do companies go bankrupt? What are the common pitfalls for companies to go bankrupt? No good financial planning, not adapting quickly enough to market changes, cash flow. Yep, these are really great answers. Too early, okay. So, loading. Okay, so the common pitfalls for companies to go bankrupt are likely because they lack one of these. And some of you may be familiar with and may not be familiar with these concepts, but I would love for you guys to Google and learn more about these concepts in your free time. But it all boils down to have cash to cover your commitments or liabilities. This is why companies go bankrupt, because they have poor cash management. Cash is king. So this is why it's important to understand where you're standing financially at all times and optimize your cash flow accordingly and quickly. So in essence, cash flow is all about revenue and cost. Increase revenue and decrease cost. If you're a pre-seed or seed stage company, you're less likely to be able to optimize your revenue because you don't really have much yet. But you will always be able to optimize your cost regardless. We're going to focus on optimizing your cost in today's session and open up to the audience to discuss different ways to optimize your revenue. Increasing revenue, even if you're still in a pre-seed or seed stage, any proof of customer traction can greatly de-risk your startup and increase revenue and potentially valuation. This is something I've emphasized a couple times already, but the goal would be to get enough customers to validate that this meets a real need, that they're keen to start using it as soon as it ships and willing to pay for it. If you were able to show your investor a list of 20 customers that were willing to talk to them or pay for your products, your chances of getting funded or generating revenue would go up substantially compared to companies who might not have this list. Let's say you just raised your seed or Series A. Your next most important milestone will be shipping the product and getting enough customers using the product to start demonstrating evidence that you have product market fit. The more customers, the better. And if they're paying, that's even better. Decreasing costs. Think about how you can reduce your cost structure. How can you optimize your operations? We're going to discuss some of the tactics to help you decrease costs. But it is key to perform the assessment and to take action. And to quote Steve Blank's statement, from the perspective of having lived through the last 3 crashes, I've observed the biggest mistake CEOs made was not, making draconian cuts to expenses quickly enough. They dripped out layoffs and cuts, holding on to favor projects, but magical thinking that somehow this was just something that would pass. You need to act now. This is the biggest takeaway I would like for you to have from today's session. Companies that really outlast this crisis will have founders and decision makers who can quickly assess new circumstances, recognize new opportunities, and act with urgency to take immediate action to pivot or restructure. Those that don't may not survive in the months ahead. If you're cash flow negative startup or about to go negative, then you need to quickly assess the new normal today and respond with speed and urgency. Your company's survival in this downturn can be captured in this simple formula, this survival equation. Your survival depends on the speed of your understanding of the situation, which is the external assessment you did to understand the state of the environment, times the magnitude of the pivots, cuts, lifeboat choices you make, and times the speed of your time to make those changes. You're a founder who can't quickly bias yourself for action, and if you wait around for someone to tell you what to do, then your investors or the market will make those decisions for you. So be decisive and do it immediately. Move with speed and urgency. You actually have days, not weeks or months. So now that we've covered all the fundamentals, what are the real tactics here? There are 7 tactics to help you reduce cost and mitigate risks. First is to cut down salaries and offer equity. Nothing is more important than assuring the company can continue to pay its employees. Before layoffs, cut all salaries by 20% and C-level staff by 30%. You want to lead by example and offer award equity to employees that's equal to the value of their reduced salaries. You want to have an open conversation and communicate clearly with all your employees about this from the get-go, so everyone has clarity. People are more likely to be receptive if you can empathize with them. Second is to freeze hiring. Stop all hiring processes if possible, and evaluate if there are critical positions where employees are willing to step up and assume additional responsibilities or new roles within the company until it enters a better financial state. Third is to accelerate accounts receivable. In other words, accelerate the process of collecting payments. Can you offer longer terms, invoice customers immediately after delivery of services, or ask customers in really good financial position to pay right away. One of the most famous examples of this strategy is when Tesla solved their cash flow crisis by increasing their customer deposits. Tesla accepts customer deposits on products which have not yet been produced. For example, when they release plans to build a new Tesla Roadster and a Tesla semi-truck, the company's customer deposits increased by roughly $168 million. So depending on your type of business, you can improve cash flow by asking clients or customers for deposits upfront to cover a portion of the products or services they will receive. Fourth is to discuss terms of accounts payables. You should get on the phone with your vendors immediately and ask for flexible payment terms or lower prices. If appropriate, maybe offer to sign a longer agreement with them in exchange for lower cash payments in 2020 and 2021. See if your fixed costs are really fixed, or will they agree to defer some for higher payments at a future date. At Hubspot, we've been offering flexible payment terms to all of our existing customers as an option to make their payments, and discounts to those who have been financially impacted. Fifth is to monitor your cash collection. Some of your customers could stop paying, right? You want to monitor collections and chargebacks frequently, as frequent as possible. You should also dial through as many of the largest existing customers to get a firsthand understanding of the magnitude of any revenue shortfall. From here, you should build a plan and develop a playbook for mitigation. How can you shift focus to customer retention versus acquisition? 6 is to draw down on debt commitments. Consider increasing your debt. It's like buying insurance. There are some costs associated with it. Finally, review your assets, bonds, and investments. Check the liquidity of your assets. The key is to solve for liquidity and solvency. More often than not, startups fail not because they don't have a killer product or a great product market fit, but because they can't solve for liquidity and solvency of their cash flow. So now let's go through a couple tactics to increase revenue. First is obviously pivoting. And a lot of you may have already considered this in your business model. So the current global health and financial crisis might mean that you need to consider pivoting your business into a new sector or direction. Think about ways your current business model could be applied to a different industry to drive value now or permanently. Think about how you can pivot verticals and value propositions as well to optimize your pipeline. What that means is you should quickly revise sales qualified verticals to those less impacted and your messaging to target buyers and decision makers. View this time as an opportunity to get your decision-making buyers engaged and focus on how you could solve a problem now, not in the future, instead of prospecting to just keep the pipeline full. Consistent revenue is not always aligned to pipeline growth. Companies that are leaning into their process to focus on quality of their pipeline versus quantity in their while engaging the decision maker and their teams are the companies least impacted in this environment. For example, if your startup is built around driving a certain value for the restaurant industry, how can you pivot to driving value for something that's in high demand right now, such as logistics? If you're very low on cash and not raising money is not an option to survive. Unfortunately, you may want to offer potential investors more attractive options to receive funding. For example, you could offer convertible notes with a bigger discount. Make sure you're very careful with this and don't make any actions that will lead to handicapping your future growth and success. You can also explore local government assistance programs. So these will look different in each region or country, but many governments are putting together resources to help companies and individuals through this tough time. In the States, some of these options include CARES Act for small business owners, or temporarily furloughing employees as an option, as well as the PPP loans, small business administration loans, and grants. But taking action financially is not the only advice here. There are 4 elements you also want to consider. First is what we talked about, rethinking your business model. Are there any iterations or pivots to your business model? For instance, Abiotic Technologies, which is a biotech startup, was able to act fast. They already possess technological abilities that could be pivoted or repurposed to the COVID opportunities. Think about looking beyond the immediate opportunities of existing customers and markets. Take a long-term view on how you can proactively identify new market opportunities. Look at your technology or abilities that you have now. Review the most attractive domains or prioritize market opportunities wisely. Second is to lead. Oh, accidentally missed that slide, but it's the same slide. So second is to lead with empathy and compassion. These are exceedingly strange times and difficult times for all of us, but we're in this together. So as painful as it might be, when you make cuts, make sure you do it once and do it right. While the layoffs create an immediate shock, people will adjust, but make sure you do it with empathy. Third is to over communicate during the times of crisis. When you build a new operating plan to adjust to the new normal, make sure you communicate these business model and operating plan changes to your employees across all levels at all times. Keep them focused on an achievable plan that they clearly understand. Let them know that as CEO, founder, or decision maker, it's your job to be micromanaging for survival of the company and expect each of them to do the same. Remind them that together you're all working to save the business and their own jobs. Finally, it's critical to get your investors on board with your new operating plan and changes. Getting their support and alignment is really vital to your success and decision making in this new environment. So don't be afraid to ask for help, and trust your board in supporting your decisions if you have a really good relationship with them. Chances are they might have survived a crisis or two, and can provide really valuable insights to your to you and your operating plan. So at some point, this crisis will run its course. Each and every business decision you make today will have its consequences in the future. But remind yourself to be relentlessly optimistic about survival, and act it out. Most importantly, be decisive and act fast. Plan and manage your business around achieving milestones before hitting your cash out of date. You don't really have time to waste. You only have days, not weeks or months. So some of the lessons I would really like for you to take away from this is to rethink your payrolls now. Can you cut down on salaries and freeze all of your hiring? Renegotiate with your vendors with creative terms, monitor money collection, and maybe think about if you can collect customer deposits upfront to help pay a portion of the future products you will deliver. And pay attention to assets, bonds, and other investments you have for the company. Most importantly, remember to act fast. Don't wait for someone to tell you what to do, because if you don't do that, if you don't make that decision, Your investors and the market will make those decisions for you. So remember, we're here to help. We're all in this together. And we did it. And with that, we conclude today's session. Um, so we still have about 15 minutes left. I'm going to open this up to the rest of the group and we can have an open conversation. Let's see, lack of a team commitment, cash flow, COVID. Are we going to receive the recording? Are we going to receive the recording and presentation copy? Yes. So we will share the recording and presentation copy with the rest of the group after today's session. Is it too late for certain companies? I don't think it's always too late to optimize your cash flow. Like I said, if you're already a cash flow negative or about to go negative startup, you can always adjust your pipeline and increase your revenue depending on what stage you're at. So that was asked by Michael. What stage are you in, Michael? What's a convertible note? So convertible notes is a type of bond that company can issue. It's almost like you're issuing debts for your investors. And this is something you may want to discuss with your lawyer to see if your company is in a good financial state to issue a convertible note for your investors. Few startups with sales, but limited, still losing money. So when you said few startups with sales but limited, still losing money, I'm assuming you're saying that you're not generating enough revenue to keep the business going. So in this case, I would reiterate your business model and really think about how you can repurpose some of the technical abilities you already have now and look into potentially new verticals. Maybe the verticals that you've been selling into, the sales qualified verticals you've been selling into, you can revise some of those verticals and look into new verticals and adjust your value propositions to see if you can still sell into some of those other new verticals, as opposed to just being fixated on your original sales qualified verticals. To any tip where to find easy to implement financial model to have good reporting and cash planning quarterly? It's a really good question. Are you asking in terms of like tech stack or just like any financial model templates to help build out your financial models? So there's actually a lot online, and for starters, I would probably recommend Steve Blank's financial model template. If you Google Steve Blank's blog, I think he's got a lot of resources for startups who want to implement useful financial models. And I know a lot of VCs have some like financial model templates in place.
Emily,
I know a lot of VCs.
sorry. In the meantime, like, well, you're right. Well, you did already. I was just adding, Michelle, if I may, that I think the most important is finding one that really fits the type of business you're going to and the phase where you are at. Because if it's a very early stage startup, you definitely want to work with different scenarios, where you have a more conservative scenario and a less conservative scenario, so you can choose and understand how much you got to before a burnout, so you can make the predictions, because you're still testing, you're still iterating, so there's a lot of going on. You need to understand how much you can invest and what riskier, what is not. So definitely there is a lot of online, like Emily just said, and I think also Steve Blank is a great reference, but definitely goes for something that you know that would make sense with the type of business model that you're working with.
100% agreed. And if it's helpful, if you already have I'm not sure if you already have like an accountant that you've been working with, I would say start with them first. They should have pretty good financial models for their startup clients that they work with to help them assess their financial states at all times. So I would say start with them first if you already have an accountant that you've been working with, because they're the professionals and they really know how to help you look at some of the numbers and dissect some of the operating numbers. And this is something that you might want to work with your CFO as well, or someone on your team who's more financially inclined to implement some of these financial models. And again, there's no one size fits all, like Alex mentioned, because it pertains to your specific business, the stage you're at, and the size of your business. So there's a lot of templates out there, but they may not be all suitable to you. So you have to, I would say, like, start with a resourceful person first, like your accountant, to build out the financial models you need. And from there, you can start iterating upon the existing financial models you have for your firm and for your business. Any questions? This is a quiet group. All right, so if no further questions, we'll give the time back to everyone. And again, the recording of today's session, along with the deck, will be sent to you after the workshop. So you should expect to see an email coming from Alex or myself afterwards. If you have any questions after the session, feel free to email me. I believe Alex will also include my information, or it's already been included in the email. So yeah, if you have any questions, feel free to connect with me. And thanks everyone for joining today's session. And I hope you found it helpful and really had some actionable takeaways from today's session.
I want to thank you, Emily, for the session. I think it was super insightful, so I'm quite happy. Thank you for the generosity and for everything you shared. I will include the recording in the deck in the email. I'll share your contacts and about the collaboration also we have with Hubspot as well. There's a lot of frameworks that you can work with to complement everything that Emily said and to maybe dig a little bit into some of the concepts. Do use the community for that as well. You will find a lot of information there. And if you have any questions, feel free to reach out, no doubt.
Yeah. And if you have any feedback about today's session, feel free to send them my way or to Alex. I would love to hear from you what you thought of today's session. I love the feedback, and that's how we grow, right? So yeah, feel free to send your feedback my way and connect with me if you have any questions. Otherwise, I wish everyone a great weekend ahead, and hopefully see you next time. Thank you all.